From the morning reading, short interest on the New York Stock Exchange and NASDAQ exchanges has reached the highest level since the financial crisis of 2008. It is unusual and often a longer-term positive to see a new high in short interest when stocks have been holding up well. And remember that holding up well comment, we're only 2-3% off the all-time highs. We are, in quotes, holding up well. While we've had a recent breakdown from the upper ranges that we've been in, stocks are certainly nowhere near even pullback and certainly not correction kind of territory. So this comment about short interest is pretty interesting. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:42 a.m. Central Time, and I'm recording this in preparation for the market day of July the 1st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's dive in and see what we've had in the overnight. There was some news on the Greek front, and whether that's the reason or just regular bounce activity, bottom line is the four broad market indices at the time of this cut are all up nicely. The S&P up about 0.84%. The Russell about 0.75%. NASDAQ just under 1%, as is the Dow. In terms of crude oil, it's down about 1.5%. Euro down about 0.4%. Bonds down about 1%, and gold down just a modicum. It's just, call it scratch kind of thing. Now China, very interesting. After yesterday's big up day, they're now down big, down 5.23% in the overnight action. Hong Kong up though about 1%. Usually you see those move like cousins, and so pretty unusual activity there. Japan also up about 0.5%. And you know what? On that Hong Kong, there must be a trade holiday or something there. That data is as of 6:30, so that would explain that. Now in 7-1, back to Japan, up about 0.5%. Germany up big, up over 2%, probably also on that Greek news, and the United Kingdom up about 1.4%. In terms of macroeconomic reports for today, another long list, and we do have some alterations to this week because of the shortened trade week. Remember, Friday is a trade holiday. Today you have ISM manufacturing PMI, crude oil inventories once the market opens, and there's several yellow reports, nothing too weighty there that's likely to move the market. Obviously you see a number of other nations also reporting. And then tomorrow we have non-farm employment. Now normally this is the first Friday of the month, but because of the trade holiday on Friday, this has moved up a day. So don't be caught unawares of that. That will be before the market opens for Thursday morning. And then of course the weekly unemployment. And let's see if there's anything else. That should take care of it for the trading week for the U.S. In terms of volatility, obviously we've had some increased activity here of late. Short-term VIX at a 20.93, still over a 20. IV percentiles really kind of mid-range, 51, 46, 50, and then the Dow at a 72. No standard deviation moves were put in yesterday. In fact, it was something of an inside day after the 2 and 3 standard deviation moves that were put in the prior day. Let's take a quick look at the charts. You notice this action here, and the question is this kind of a dead cat bounce? You know, certainly the lows held, and that's always important. And at one time, it looked like, this was going to be a, pretty significant kind of bullish candle, but then pulled way back from those highs of the day. We end up with this small body, and you know, it's really, the question is it a dead cat bounce? Because a dead cat bounce, you come down big, bounce, and then roll back over. If we do roll back over, then you would kind of expect this area with the 61.8 fib extension and the prior swing low to be an important area. So kind of keep that 2039 area in mind. Now that being said, our overnight action seems to have us up big. So that seems to be kind of totally off the table. But if we're up big and then reject once the cash open occurs, you know, that would be really quite a weak sign. So we need to see where this follow through comes through. We are at something of a decision point. Also keep in mind that seasonality has an influence on today. Today is the first day of the third quarter, and you know, it's the day that mutual funds usually get big incursions of cash from the 401ks that come in on the 1st and 15th or 16th of the month. So normally a bullish seasonality, and this is held up pretty consistently, whether you look at the first day of the month or you look at the first day of July. You know, I think it's something like 20 of the last 25 years this has been an up day. So let's see what kind of up day this might be, if indeed we get that follow through. If we open up, you know, 18 points or something like that, but then close up 4 or some sort of similar thing, then that would be a false up day. So between close to close, it's up, but yet the action on the day, it's red candle. So a false up day, and a false up day is not a strong candle. So we want to kind of see what kind of character this action has today. Do we open up and then drive and continue a bullish push, or do we falter and fall back and create some sort of false up day? On the other indices, we had similar action to yesterday's SPX. On the Russell, you see a red candle here, but you know, very much kind of like that dead cat bounce potential candle. NASDAQ, this one was, you know, more of a harami pattern, but red. So, you know, not, it's obviously it's an inside day. That's probably the best statement to make about that. Inside day. After a great big, you know, 3 standard deviation type move, having an inside day is not expected, or not unexpected, but it's certainly not as bullish as we might had hoped, and something of a bounce and reversal. And then the Dow, you can see very much like the S&P, its cousin. Bonds, also a big reversal intraday. So not very, very encouraging there. And transportation, you know, again, something of a dead cat type bounce potential. So pretty interesting things going on in our charts today. In terms of a regular daily report, there's a sea of red here, and you know, obviously much carryover from the day before. There was nothing in the action yesterday that's going to improve these hedge risk levels. We are still in phase 5, the break of diagonal and horizontal support. It'll be interesting to see if this becomes a, you know, head fake for the bears and then back into the trading range. That has not yet happened, but we'll watch to see if that happens. IPD status remains uptrend under pressure. Accumulation distribution in the S&P is a D- and the NASDAQ is a D+. GMI index fell to a 1 out of 6, and it issued a new sell signal. So that is an additional warning flag. Intermediate term market posture, very bullish. Excuse me, very bearish. S&P is at 32.7, very bearish. Dow 22.9, at the edge of becoming severely bearish. NASDAQ 45.2, also very bearish, and only the Russell, you know, is, you know, a weaker bear at 58.7. But none of these are painting very good pictures, and none of them would be calling for, especially with novice traders or less aggressive traders, for new short-term or intermediate-term bullish trades to be initiated. Hedge warning status is indeed still a threshold level 2. This is the red light. Now, in recent months, whenever we've had a level 2, we've quickly seen rejection off of those bearish probes and then back into the range. Question remains, does that happen this time? The Greek news could certainly have a lot to do with that. In terms of our volatility-based warnings, they're basically all firing. Market in decline, sharp increase warning, VIX spike, the VIX over 18. The VIX, has fired a daily squeeze to the long side. Obviously, that subsided a bit yesterday, but still, it is fired long. So that, warns of potential increased volatility to continue. Distribution day count continues to be very high at 7 and 5. You have a ratio warning, as well as obviously the VIX phase is climbing. We do not have a skew warning, but it was really, really close, just under 125. If it gets to 125, we consider that, be something of a cautionary level, and it was just shy of that. If it hits 135, we consider that a significant warning of further downside action, and we did not have that. New highs, new lows. Obviously, again, back-to-back days, very, very weak, with 672 new lows being put in. And our risk aversion indicators, all 5, still remain as risk off. In terms of the special opinions, option income strategies, VIX is outside the acceptable window. Novice traders should not initiate new positions. More aggressive traders need to take into account, obviously, the volatility. Covered call. Novice traders should not initiate new positions, is the opinion. Aggressive traders should use a 1-to-1 distribution between in the money and out of the money strikes, especially if, keep that distribution in mind, even if you're a novice trader and you're managing an existing position. If you have occasion to roll it out to another month, you might want to go to this 1-to-1 distribution between in the money and out of the money strikes. Give yourself some downside protection if this market should break down. Put selling conditions are not acceptable for new core put portfolio positions. If you are a novice, aggressive traders should consider put credit spreads with defined risk and consider scaling into positions until the market has confirmed a more bullish posture. And in terms of the sector specific, obviously a sea of red here, nothing really to get excited about if you are a bull. In terms of and let's back here just a moment here. So if you were a bear, you might say, well, which ones are the most negative and that I might take a position there? Well, we're not in a situation yet where it's clear sailing for initiation of bearish trades. You might have some in your mix, but while we are certainly at a hedge risk level 2 and at increased levels of risk, this is not a call for an outright bearish posture. So while our intermediate term forecast is bearish, we've seen the recent history of these things that these have not lasted very long. So initiating new bearish swing positions, need to be pretty nimble. And kind of keep that in mind. So it's more of a situation, in my opinion, to where it's a poor environment to initiate bullish positions, not necessarily a great environment to initiate a boatload of bearish positions. So caution for the bulls, caution for the bears is probably the byword at this point. So in terms of sector percent change, obviously a better day put in yesterday, and you see most of the sectors were positive. Consumer staples, utilities, telecommunications, all negative, but kind of a mixed bag from that aspect. Very mixed bag, though, if you look at the 1 day versus 5 day, 1 month, and even into the 3 month. This has not been a great quarter that just closed. In fact, I did take a look at some data looking at all the benchmarks for the quarter and the year-to-date performance, and pretty poor, really. And international currencies, sectors, industry groups, all the traditional benchmarks and so forth, and very, very poor returns that have been in the recent quarter and in many cases in the year to date. So just kind of keep that as part of the context of your trading as you initiate new positions. Sometimes the very best thing to do is sit on hands and sit in cash. I know I saw a comment from the author of the GMI index that in terms of his trading capital, he was mostly in cash, and then in his retirement, he was mostly in mutual funds where he was limited in his ability to trade in and out with the rules. But I thought it pretty interesting, his comment that he was mostly in cash with respect to his trading capital. So I think that's probably a pretty good comment about where we are right now, and certainly we would agree with a hedge risk level 2 in our own system, calling for very, very cautious posture and being able to initiate new bullish positions, whether they be short or intermediate term. So that should be probably enough for today. As always, we greatly appreciate you liking us on YouTube if you find this helpful. If you came to us from Twitter or StockTwits or something like that, liking us or retweeting us, greatly appreciated as always. Greatly, bottom line, we depend on your word of mouth and sharing us with your trader community if you find helpful resources here to your own trading. Additional information is available at this website. Performance matters, we get that, and we're very transparent in our actions. This is a model position size, of course. You can be larger or smaller. Disclaimers as always, hit the pause button if you need more time to review this. And we'll look forward to seeing you back here tomorrow morning before the market opens with the market preview from Falcon Global.